Hey everyone, Michael Petrovich Team Home Loan. Today I'm going to go over the advantages and disadvantages of an FHA loan in Papillion, Nebraska. FHA loans, great program, really useful for people that may not quite fit into conventional financing guidelines. Also, a low down payment program. FHA allows a down payment as low as 3.5% of the purchase price. So, if you're buying a $100,000 house, it's a $3,500 purchase price. The really good thing about this is that FHA will allow this low down payment even with less than perfect credit. So FHA will go down to 580 with that 3.5% down payment. Now, I don't like to do loans below 620. The rates on FHA and the fees on FHA get a lot worse below 620, and the loan becomes, even though they'll take it, they start to scrutinize things a lot more. So the loan gets a lot more difficult to do, a lot more stressful. So we'll look at your credits. If you're below 620, we'll try to find opportunities to get you above that 620, get you that better rate, get you those better fees before you move forward. A lot of times it's very simple we can do to get your credit scores up, but they will go down to 580 with that 3.5% down payment. FHA also, the rates on FHA are actually better usually than conventional financing. So FHA always has lower rates than conventional financing. Always, yeah, it's almost always lower rates on conventional financing. And also FHA is not as sensitive to credit score. So if you have a less than perfect credit score, the rate's going to be a lot better than conventional. So conventional, the rate is really affected by your credit score. So it starts to creep up the lower your credit score. Where FHA, if you have perfect credit, you get a great rate. If you have less than perfect credit, maybe mid 600, 620, the rate's going to be higher, but not as much of a jump as if it were conventional. FHA also allows higher seller credits than conventional at that lower down payment. So at 3.5%, FHA will allow the seller to give you up to 6% of the purchase price in credits. That can only go towards the escrow and the closing costs. They cannot contribute to your down payment. They cannot give you extra funds outside the closing, but they can contribute up to 6% of the purchase price in credits for those items. And in Papillion, in Nebraska in general, you rarely have those items, the escrow and the closing costs, higher than 6%. So the seller, if you can get them to agree to that, that's something you'll negotiate in the contract. The seller can cover all costs associated with the loan. So you're just bringing in the down payment. FHA allows higher debt ratios. So what that means is that we're going to look at your gross monthly income. We're going to look at the total mortgage payment and then the total debts showing on your credit, and then anything like alimony, child support, bankruptcy payments, tax lien payments. And we're going to see what your housing debt ratio is compared to your income, and what your total debt ratio is, which is the housing payment, the house payment, plus all debts showing, all those other debts showing on your credit report and those other items I just listed. FHA will allow a higher debt ratio than conventional. So you can go to, on the total debt ratio, almost to 57%. So all your debts combined can be 57%, just under 57% of your gross monthly income, whereas conventional is going to stick to at least under 50, sometimes under 45. Housing ratio can also go into the 40s. So this is good for people that maybe are just starting out with their job and maybe don't have enough income now, but think they're going to have some in the future. Or in a case where maybe someone's going to live in the house that is not on the loan, so we can't use their income, we can qualify you with your higher income, and just knowing that you're going to have that extra income from that other person in the house. So that is an option as well. So FHA also allows a non-occupying co-signer. It has to be a family member, has to be a close family member, can't be a distant relative, can't be a cousin, but they will allow a co-signer that's not living in the house to help you qualify for financing. So let's say you don't meet the debt ratio requirements or the credit requirements. You can have a parent or aunt, uncle, sister, brother co-sign with you on the loan, and we'll use their income, their credit, their assets, as well as yours to get you qualified. Very common with parents trying to buy houses for their kids, and maybe don't have an established credit history, maybe don't have a lot of income, but they want to get them into a house they can start building that house equity as soon as possible. So very common with that. Also on that, they used to call it the kitty condo program, where a parent could buy a house, and you can still do this, buy a house for their kid that did not have a job, so they had no income, and as long as we qualified them with all the income from their parents, they could still afford that new house payment. They could buy their kids a house, say during college, so that by the time they got out of college, 4 or 5 years later, they had all that equity in a house that they lived in. They could also have their friends live there and pay them rent, so they're paying the mortgage, but the parents could qualify with them even if the kid did not have a job. They could be the primary resident of that house. Okay, so what are the disadvantages of FHA? FHA has high mortgage insurance. So you're going to pay monthly mortgage insurance just like you would on conventional. There's going to be mortgage insurance if you're not on conventional. If you're putting 20% down, you don't have mortgage insurance. But FHA has high mortgage insurance. So it's typically higher than conventional. In almost every case, unless your scores are lower and we're going conventional, the FHA mortgage insurance is going to be higher. The FHA mortgage insurance also never drops off. So conventional, once you get 20% equity, that mortgage insurance drops off. FHA, doesn't matter how much equity you have, that MI, that mortgage insurance, is on there for the life of the loan. FHA also has something called upfront mortgage insurance, which is a bit confusing. It always confuses people when we first start out, is that in addition to that monthly MI fee, you're also going to pay a flat fee, which is rolled into the loan at close. It's 1.75%. It's a fee that's rolled into the loan. An example of this would be, if you're buying a $100,000 house, your base loan amount is going to be $96,500 because you're putting that 3.5% down. But your total loan amount is going to be $98,250 because we're going to tack on that 1.75% funding fee. So you're not bringing it to closing; it's just being rolled into the loan. So your loan amount's going to be that much higher on an FHA loan. So you're bringing in 3.5%, but then they're also tacking 1.75% on top of that. So that is something to consider on FHA, that there is going to be that additional fee in addition to that monthly MI. The FHA is only for your primary home. So you cannot use it to buy investment property. You cannot use it to buy a second home. You cannot use it to buy a vacation home. So it's only for people looking to buy the house they're going to live in. Conventional obviously has a lot more options with that FHA just doesn't have. FHA, you're only allowed to have one FHA loan out at a time. So if you buy a house FHA, move out of it, and back to the last point, you can buy an FHA home, use a loan to buy your primary house, and then later on down the road, you can move out of it and convert it to an investment property and buy another house. So it does, even though you have to buy it as a primary house, you can later on down the road move out, keep the house, keep that loan, and just use it as an investment. They're not going to require you to refinance or get a different loan program. They will allow you to make that an investment property. But you can only have one FHA loan out at a time. So if you do have an FHA loan, you move out, want to convert that house to a rental and buy another one, you cannot get a second FHA loan. You have to go conventional, some other program. So you only have one active FHA loan at a time. There are some exceptions to this. They're rarely used just because FHA is very strict about how they approve them. You could, if your family size, you can prove your family size got too big for the house and you cannot afford any other, not qualify for any other loan program, they're technically are going to do that, though I've never seen them approve that. Or if you're moving for work more than 100 miles away from your current house, can't commute, need to buy another house, and can't qualify for another program, FHA will allow a second one in that case. Also very difficult to do. They really kind of scrutinize that stuff a lot. So typically just one FHA loan out at a time. Okay, so FHA, it's typically a program for someone that doesn't meet conventional guidelines. Even though conventional rates are higher, conventional has a lot of advantages over FHA with that MI, with that upfront MI, that kind of stuff. That if you have a large down payment, if you have excellent credit, if you have low debt ratios, typically we're going to look at the conventional loan first. And if we can't get you into that program, we're going to look at the FHA option. So FHA is more of a fallback. It kind of just expands options for people that don't fit into that conventional program. So if you think you don't qualify for financing, a lot of people reach out to me, think they don't qualify, find out they do through the FHA program. They think their debt ratio is too high, their credit's not good enough, they don't have enough income, and find out if they actually do qualify. So if you think you might not qualify, just check, just reach out, give me a call, send me an email, send us a message through our website, and we'll just have a discussion with you about where you're at. And we can pretty much tell right there if you're going to be close or if you're definitely fit in that FHA program. So give us a call. All right. Thanks a lot.